Meet Ethan and James. They're both 30 years old. They both earn $70,000 a year. For the past few years, they've both lived carefully, cutting back where they could, and they've each just finished building something most people never quite get around to finishing, a fully funded 6-month emergency fund of $21,000, sitting safely in a high-yield savings account. For both of them, this feels like the finish line. It isn't. It's actually where the real decision begins. From this point forward, both of them save an extra $500 every single month. That's where the similarity ends, and it's the only variable we're going to track. Same age, same income, same starting cushion, same monthly savings rate. The only thing that changes is what they do with the money after the safety net is already built. Let's follow them for the next 20 years, because the ending surprises almost everyone. Let's begin. There are 5 things that decide how this story ends nearly $100,000 apart, and once you see them, the ending stops feeling like a twist. Point 1, the same starting line, 2 different instincts. Point 2, why feeling safe and being safe are not the same thing. Point 3, where the actual line between them was, once you look back at all 20 years. Point 4, the exceptions that change where that line should sit. Point 5, the real-world proof, and exactly how to draw the line for yourself. Let's start with point 1. Point 1, the same starting line, 2 different instincts. Ethan has always believed that more savings means more safety. It's a simple belief, and on the surface, it's hard to argue with. So every month, her extra $500 goes into the exact same account as her emergency fund. No new decisions to make, no risk to think about, just a number that keeps climbing. It feels responsible. It feels like exactly what a careful person would do. James sees it differently. He believes his job as a saver ended the moment his 6 months of expenses were fully covered. Anything beyond that isn't protection anymore, it's just idle money. So every month, his extra $500 goes into a diversified stock market index fund instead. His original $21,000 stays exactly where it is, untouched, still doing its job as a safety net. But every additional dollar goes to work somewhere else entirely. On day 1, you genuinely can't tell them apart. Both have identical bank balances. Both technically have the same level of protection against a real emergency. If James's car breaks down tomorrow, he's just as covered as Ethan. This isn't a story about one of them being reckless. It's a story about what happens to the money that shows up after the real risk is already handled. The first year passes quietly for both of them. Ethan checks her account and watches the number tick upward every month, steady and predictable. James checks his brokerage app and sees something messy, some months up, some months slightly down, never in a straight line. Ethan's balance feels safer to look at. James's feels less certain. But feeling safer and being safer are 2 different things, and that gap is exactly what we're about to measure. 3 years in, the numbers start to speak for themselves. Ethan's extra contributions, earning a modest savings rate the entire time, have grown to roughly $19,000. James's invested contributions, assuming a long-term average return in the ballpark of 7% after inflation, have grown to nearly $20,000. It's a small gap. Barely worth mentioning. If you stopped the story here, you'd say they made basically the same decision. But something else has been happening quietly in the background that neither of their account balances shows directly. Economist Anna Maria Lusardi has spent years studying financial fragility in American households, including a widely cited study she conducted with economist Peter Tufano, which found that a large share of people couldn't cover even a modest unexpected expense without borrowing or selling something. Ethan and James don't have that problem. Their original $21,000 sits untouched for both of them, doing exactly what it's supposed to do. The real story here was never about who's more protected. It's about what happens to everything built on top of that protection. Point 2, feeling safe versus being safe. 5 years in, the gap starts to widen in a way that's harder to ignore. Ethan's extra savings sit around $33,000. James's invested contributions have grown to roughly $36,000. Still not dramatic. Still the kind of difference you could shrug off at a dinner party. Ethan isn't worried. Why would she be? Her number keeps growing every single month, and it never once goes down. That predictability feels like proof she made the right call. Here's where economist Robert Shiller's research on market psychology becomes useful in understanding what's actually happening beneath the surface. Shiller has written extensively about how financial decisions are shaped less by spreadsheets and more by narrative, and by how differently gains and losses feel even when the underlying math treats them the same. Watching an investment account dip, even slightly, triggers something psychologically that watching a savings account sit perfectly flat simply doesn't. Ethan isn't making a math mistake at this point in the story. She's making a comfort purchase, and comfort, it turns out, has a price tag attached to it that doesn't show up until much later. 10 years in, the comparison becomes genuinely interesting. Ethan's extra savings have grown to about $69,000. James's invested contributions have grown to roughly $87,000. Now the gap is real money, not a rounding error. Ethan starts to notice it too. She glances at James's numbers, feels a flicker of doubt, and then reminds herself why she chose the path she did. Her money has never dropped in a single month. Not once. James's has dropped plenty of times, sometimes sharply, and he's had to just sit there and watch it happen without touching it. Somewhere around year 11, the market goes through one of its periodic downturns, the kind that shows up every decade or so and makes headlines for weeks. James watches his invested balance drop by nearly a quarter in the span of a few months. It's uncomfortable. He didn't enjoy watching it happen. But here's what actually matters in that moment: his emergency fund, the original $21,000, isn't touched by any of it, because it was never invested in the first place. It sits in its boring account, completely unaffected, doing exactly the job it was built for. James doesn't need to sell a single share to cover a real expense, because the real expense coverage was never the investment account's responsibility to begin with. This is the part of the story worth pausing on, because it's the exact argument people raise against James's approach, and it's worth answering directly. What if the market crashes right when he needs the money? The honest answer is that it doesn't matter, because the money he needs in an actual emergency was never in the market. The line James drew wasn't just about growth, it was about separating the money that has to be there tomorrow from the money that has decades to recover from a bad year. Ethan's approach protects her from a scenario that, for both of them, was already handled the moment the original $21,000 was fully funded. A year later, the market recovers, as it historically tends to do over any long enough stretch, and James's balance not only returns to where it was, it continues climbing from there. Ethan, watching from the sidelines, feels a brief moment of vindication during the downturn, quickly followed by the same slow realization she's had a few times already, that her caution never actually protected her from anything James wasn't already protected from too. Around this same period, something small but telling happens between them. Ethan mentions her growing savings balance to a coworker, who nods politely and asks how much interest she's earning. She hesitates before answering, because saying the number out loud makes her uneasy in a way she can't quite explain. James, when asked a similar question at a family gathering, shrugs and says he honestly doesn't check his account that often anymore. Neither conversation changes anything about their finances. But there's a small window into how differently the same underlying decision starts to feel once you've been living inside it for over a decade. 15 years in, Ethan's extra savings sit around $115,000. A big number. A number she's proud of. James's invested contributions have grown to roughly $168,000. The gap is no longer something either of them can pretend not to notice. Ethan starts asking herself a question she's avoided for years. Was all of that caution actually protecting her from anything, or was it just protecting her from a feeling? 20 years in, we get our answer, and it's not close. Ethan's extra savings have grown to approximately $164,000. James's invested contributions have grown to approximately $260,000. Same monthly amount. Same starting point. Same original safety net, still sitting there for both of them, never touched, never needed for anything beyond its purpose. The only difference across 2 full decades was where the money went after the actual emergency fund was already finished. That single decision, repeated every month for 20 years, created a gap of nearly $100,000. Point 3, where the actual line was. Here's what makes this story different from most financial comparisons. Ethan never did anything reckless. She never gambled, never chased a hot stock, never made an emotional decision she'd regret. She did something that looked careful in every single month it happened. That's exactly what makes this mistake so easy to make and so hard to notice. It never once looks like a mistake while it's happening. It only reveals itself decades later, as a very large, very quiet gap between two people who started in the exact same place. So what was Ethan's actual error? It wasn't building an emergency fund. That part was correct, necessary, and something both of them did exactly right. Her error was never defining a stopping point. She built the safety net, and then she kept building it, because stopping felt uncertain and continuing felt safe, even though continuing was no longer protecting her from anything new. James's advantage wasn't bravery either. He wasn't taking on some heroic risk that Ethan was too scared to take. He simply drew a clear line. Below this number, the money stays liquid and protected, no exceptions. Above this number, the money goes to work, no exceptions. That line is the entire difference between their outcomes, and it cost him nothing extra to draw it. It just required deciding, in advance, where safety ends and growth begins. Point 4, the exceptions that change the line. There's a version of this story that plays out even faster for people whose income doesn't arrive in steady paychecks. Imagine a third person, Priya, a freelance designer with the same $21,000 emergency fund, but an income that swings wildly between strong months and lean ones. In a good quarter, Priya might bring in double what Ethan or James earn in the same stretch. In a slow quarter, she might bring in almost nothing at all. For Priya, the line James drew isn't quite enough on its own. Her correct approach means treating every strong month as a chance to first check whether her fund has been drawn down since the last lean stretch, topping it back up before anything extra gets invested. Skip that step, and a freelancer can end up investing aggressively during a good quarter, only to find the safety net thinner than expected the moment the next slow month arrives. The rule doesn't change. The order of checking it does. There's a related pattern worth naming too, one that shows up specifically when two people are managing this decision together instead of alone. Picture a couple where one partner shares Ethan's instinct toward comfort and the other shares James's instinct toward growth. Left unresolved, this often turns into an emotional compromise instead of a calculated one, keeping more cash than either the math or the household's actual risk justifies, simply to avoid an ongoing disagreement. That isn't a financial decision, it's a truce. The healthier version of that conversation separates the two questions entirely. First, agree together on the real number, based on actual essential expenses and actual income stability, not on how anxious either partner feels on a given day. Only after that number is settled does it make sense to talk about comfort, and even then, comfort should be named honestly as a preference, not quietly folded into the safety calculation where it inflates the target past what real risk requires. Point 5. The real-world proof, and how to draw your own line around year 6, both of them get an unexpected windfall in the same month, an inheritance from a distant relative, small but real, about $8,000 each. Ethan does exactly what you'd expect, it goes straight into the same savings account, on top of a fund that's already grown well past its original target. James does something slightly different, and it's worth pointing out precisely because it isn't automatic. Before investing a cent of it, he checks his own number first. His fund is already fully intact, untouched, sitting right where it should be. Only after confirming that does the entire $8,000 go straight into his investment account. If his fund had been sitting below target for any reason, the windfall would have gone there first, no exceptions, regardless of how tempting it felt to chase growth with it instead. That single habit, checking before investing, is the quiet difference between someone who's disciplined and someone who's just gotten lucky so far. Around year 13, both of them get a real test, not a hypothetical one. Ethan's car needs a transmission repair that costs $4,200. In the same month, James's water heater fails and needs full replacement, running him $3,600. Both handle it the exact same way, withdrawal from their emergency fund, paid in full, no debt, no stress, no disruption to anything else in their lives. This is the part of the story that matters most and gets overlooked the most. Both of them were completely protected. James's decision to invest everything beyond his fund never once put him at risk during an actual emergency, because the fund itself, the part that mattered, was identical for both of them the entire time. The only thing that differed was what happened to the money that was never going to be needed for a transmission or a water heater in the first place. There's also a quieter cost sitting inside Ethan's decision that never shows up as a dramatic loss, only as a slow leak. Cash sitting in even a strong savings account tends to just barely keep pace with inflation, sometimes falling slightly behind depending on the rate environment. That's a completely acceptable trade for the actual emergency fund, because that money's entire job is to sit there and not move. But for every dollar stacked on top of it, that same inflation quietly erodes purchasing power year after year, with nothing growing underneath to offset it. Behavioral economist Richard Thaler's research on mental accounting helps explain why this goes unnoticed for so long. People tend to treat money labeled savings as fundamentally different from money labeled investing, even when both are simply dollars capable of doing the same job. Once a dollar gets mentally filed under safe, it tends to stay filed there indefinitely, long after the actual need for that label has passed. So if you're listening to this trying to figure out which path actually fits you, here's how to draw your own line the way James did, instead of drifting the way Ethan did. Start with your essential monthly expenses, not your total spending, just the non-negotiables: housing, utilities, groceries, insurance, minimum debt payments. Multiply that number by a range that matches your real risk: 3 months if your income is stable and easily replaceable, 6 months or more if it isn't, more still if you're the only income in your household. Keep that fund somewhere boring on purpose: a high-yield savings account, a money market fund, something you can access within a day or two without losing a cent of it. And then, the part almost nobody does. Once you hit that number, stop. Not because saving is bad, but because that specific job is finished. Everything beyond it has a different job to do, and keeping it in the same account where it can't grow isn't protecting you from anything additional, it's just costing you the difference between where it sits now and where it could have been 20 years from now. If you're self-employed or your income swings the way Priya's does, size your fund around your worst realistic stretch of low months, not a single hypothetical zero-income month, and treat every strong month as a chance to refill before you invest. If you're managing this with a partner, settle the actual number together using real numbers first, and have the comfort conversation as its own separate discussion afterward, not folded quietly into the target itself. And if a windfall shows up, whether it's a bonus, a refund, or an inheritance like the one Ethan and James each received, check your number before you do anything else with it. That one habit alone prevents most of the mistakes in this entire story. Revisit the number once a year, when your income changes, when your expenses change, when the people depending on you change. Adjust it when it needs adjusting, and leave it alone when it doesn't. That's the entire strategy. It isn't complicated. It just requires deciding where the line actually is, instead of letting comfort quietly move it further every single year. Ethan and James started in the exact same place, made the exact same sacrifices to get there, and ended up nearly $100,000 apart, not because one of them was braver, and not because one of them was smarter. Because one of them drew a line, and the other one never did.